This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, August 24, 2026, and this is the London session. Now, let's get into it. The Fear and Greed Index is sitting at 14, deep in extreme fear territory. Investors are fleeing risk and parking capital in the US dollar and gold, pushing the safe haven bid to multi-year highs. But the real story isn't just the fear. It's the technical battle happening right now at the 200-day moving average. Dollar Canadian is testing a major resistance level that could define the next week for the entire dollar complex. We are hours away from the Jackson Hole gathering, where the Fed's next move will be scrutinized like never before. Let's get to the data. Before the pre-market opens, here is what is on the calendar. The highest impact event this week lands on Wednesday, August 26th, in 2 days' time. That is when we get the Institute for Supply Management Manufacturing PMI for the United States, along with the Personal Consumption Expenditures Price Index, the Federal Reserve's preferred inflation gauge. These numbers will be the primary catalyst for the dollar as markets brace for the Jackson Hole event later in the week. Later that same day, we also have the GDP Now estimate. On Thursday, August 27th, we have the weekly jobless claims report for the U.S. On the international side, the European Central Bank makes its policy decision on Thursday, March 6th. Though that is a placeholder for a different calendar, the focus remains on the U.S. data releases this week.
The key thing to watch for on Wednesday is whether the PCE price index confirms the sticky inflation we are seeing, or if it finally gives the Fed the confidence to pivot. That single number will dictate whether the dollar strength we see today is a one-day wonder or a trend.
Here is the current landscape. The Fear and Greed Index is at 14 out of 100, signaling extreme fear. Only 10% of tracked assets are currently declining, which is unusual for this level of fear. It suggests that while sentiment is panicked, the selling pressure is concentrated rather than broad-based. Let's look at the headlines driving this move. First, Dollar Canadian is moving higher into the 200-day moving average resistance, acting as a key barometer for buyers and sellers. This is following data showing Canadian advanced manufacturing sales in July fell 0.2%.
The flow data confirms the dollar's dominance here. We are seeing leveraged funds strongly bearish on the Canadian dollar, with net short positions near 89,000 contracts. The smart money is not betting on a Canadian dollar recovery.
Second headline, gold remains supported into the Jackson Hole event after the U.S. Treasury ignited debasement trades. This comes as the Treasury could tap the Treasury General account, which holds nearly $1 trillion, to fund bond buybacks. This is a classic safe haven rotation. With the Fed funds rate at 3.63% and core PCE inflation holding at 3.29% year over year, the market is pricing in a prolonged period of restrictive policy. That environment favors gold as a hedge against currency debasement, even if real yields are high. Third headline, stock market sector rotation update shows industrials joining technology in cooling off. This sector-wide weakness is feeding back into the risk-off FX environment.
I am watching the volatility data closely here. The VIX closed yesterday at 15.13. Sitting in a 5-day range of 14.77 to 16.14. The fact that volatility is low while the Fear and Greed Index is at 14 is a divergence. Usually, when fear is this high, the VIX spikes. The fact that it is subdued suggests the market is complacent. That is a risk. If the VIX expands rapidly on Wednesday with the PCE data, the dollar strength could accelerate sharply.
Let's start with our priority one ticker, Dollar Canadian, Dollar CAD. It is trading at 1.3792, up 0.19%. Grid, you own the technicals here. What is the chart telling you?
The structure is clear. we are testing the 200-day moving average, which aligns with the 5-day high of 1.3908. The price action from Monday, August 19th saw a high of 1.3908, and we have been grinding up toward that level since. The 5-day low was 1.37321. We are currently sitting right in the middle of that range. The volume is confirming the move higher. Every time we pull back to 1.376, buyers are stepping in. The resistance is at the recent high of 1.3908. If we break that, the path is open. If we reject here, we drop back to the 5-day low support.
The positioning data backs the technicals. The CFTC Commitments of Traders report from August 18th shows leveraged funds are strongly bearish on the Canadian dollar, with a net position of negative 88,897 contracts. That is a massive short bias. When you have that much short positioning and price is rising into resistance, you have two outcomes. Either the shorts cover and fuel a breakout, or the price stalls and they get trapped. Right now, the flow is consistent with a breakout attempt.
Let me stress test that breakout thesis. You are talking about a breakout above 1.3908, but look at the broader context. The U.S. Treasury is potentially tapping the TGA to fund bond buybacks. That is liquidity draining from the system. Historically, when liquidity drains and risk sentiment is at 14, those resistance levels hold. The technical breakout you are seeing grid might just be a liquidity trap. The data shows only 10% of assets are declining, which means the broader market is not confirming this dollar strength. A breakout here could be a bull trap that reverses hard if the PCE data comes in hot and forces a policy repricing.
The data is the data. The price is at 1.3792. The high is 1.3908. I am watching the 1.38 level as immediate support. If that holds, the trend is up. The trap argument is speculative until we see a rejection candle.
Moving to our second priority, gold, XAU dollar. It is trading at 4,639, up 0.69%. This is a major move. Let's talk about the fundamental drivers here. Pulse, what is the macro setup for gold?
The macro setup is heavily skewed toward gold. The federal funds rate is at 3.63%. Core PCE inflation is at 3.29%. Real yields are a complex function of these two numbers, but the market narrative right now is debasement. The U.S. Treasury is looking at bond buybacks, which signals a willingness to manage the debt load through inflationary mechanisms. With the fear and greed index at 14, capital is fleeing risk assets and parking in hard assets. The yield curve is normal at positive 50 basis points, which usually supports growth, but the inflation number is sticky. That combination favors gold as a store of value.
The flows are interesting here. The CFTC data shows leveraged funds are actually strongly bearish on gold, with a net position of negative 670 contracts. That is a very small number compared to the price move, but the direction is short. Asset managers are net zero. This is a retail and flow-driven rally, not an institutional one. Usually, when price breaks out on bearish positioning, it suggests a squeeze. The shorts are getting crushed as the price hits 4,639.
Technically, the chart is screaming bullish. The 5-day high is 4,657.1. We are currently at 4,639, just $300 off the high. The 5-day low was 4,324.64. The move from that low to the current price is a massive expansion. The price action on Monday, August 19th saw a close at 4,511. Since then, it has rallied through 4,500, 4,600. The support is now at 4,600. If we hold that, the next level is the high at 4,657.
I have to challenge the gold narrative here. You are calling it a safe haven bid, but look at the volatility. The VIX closed yesterday at 15.13. It is low. Low volatility in a high-fear environment is dangerous. If the VIX expands, gold could sell off as margin calls force liquidation across all correlated assets. Furthermore, the U.S. dollar is strong. The trade-weighted dollar index is at 118.90. A strong dollar is the historical enemy of gold. You are saying the debasement trade is driving this, but the data shows the dollar is firm. If the dollar breaks higher on Wednesday's PCE data, gold could drop sharply. The bearish COT positioning is a warning sign.
The dollar is firm, yes, but the dollar is also falling in the broader context. The trade-weighted dollar index had a week-over-week change of negative 0.28. The dollar is losing ground even if it is up against the Canadian dollar. The real driver here is the Jackson Hole event. Everyone is positioning for a Fed pivot. That pivot narrative is what is buying gold.
Let's move to euro dollar. It is trading at 1.1679, essentially flat. CIPHER, you mentioned positioning earlier. What is happening with the euro?
The CFTC data is stark. Leveraged funds are strongly bearish on the euro, with a net position of negative 57,716 contracts. That is a massive shift, a week-over-week change of negative 58,330 contracts. This is a panic sell-off in the euro by speculators. Asset managers are net long 237,426 contracts. So you have speculators dumping the euro and long-term holders accumulating. This divergence is key. Usually, when speculators are this bearish, a reversal is possible. But the price is not moving. It is stuck at 1.1679.
The chart shows a consolidation pattern. The 5-day high is 1.17117. The 5-day low is 1.15701. We are trading near the midpoint. The price action on Monday, August 19th, opened at 1.15761 and closed at 1.16744. Since then, it has been range-bound. The resistance is at the high of 1.17117. Support is at the low of 1.15701. The volume is low. This is a waiting game.
The range-bound action in a high-fear environment is a warning. The VIX is low, but the fear and greed is 14. This suggests the market is holding its breath. The bearish positioning in the euro is extreme. If the US data on Wednesday is strong, the euro could break down toward 1.157. But if the data is weak, the euro could rally. The risk is asymmetric. The downside risk to the euro is higher because the dollar is the dominant force right now.
Finally, let's look at dollar yen. It is trading at 158.923, down 0.04%. Pulse, what is the policy divergence here?
A policy divergence is the key story. The Fed funds rate is at 3.63%. The Bank of Japan is still in a very accommodative stance, though they have raised rates recently. The 2-year Treasury yield is at 4.19%. The 10-year is at 4.69%. The yield curve is normal. This yield advantage supports the dollar against the yen. However, the fear sentiment at 14 is causing a flight to safety, and the yen is a traditional safe haven. So you have two forces pulling in opposite directions: yield support for the dollar and safe haven demand for the yen. The price is stuck at 158.
The positioning data is heavily bearish on the yen. Leveraged funds are strongly bearish on the Japanese yen, with a net position of negative 67,971 contracts. That is a massive short bias. This is consistent with the carry trade. As long as the Fed stays high and the BOJ stays low, these shorts remain. But if Jackson Hole signals a Fed cut, those shorts could rush for the exits.
Technically, the 5-day high is 159.5575. The 5-day low is 158.0295. We are trading at 158.92. The price is near the middle of the range. The structure is neutral. The resistance is at the high and support is at the low. There is no clear trend here. It is a consolidation pattern.
The consolidation is the risk. With the VIX at 15.13, the market is complacent. If the BOJ intervenes or if the Fed signals a cut, the yen could rally sharply. The short positioning is extreme. A short squeeze in dollar-yen could be violent. I am watching the 158 level closely. If we break below that, the trend could reverse quickly.
Let me tie this together. Pulse highlighted the macro divergence between sticky inflation and the Fed's potential pivot. Grid showed us that dollar CAD is testing a major resistance level at 1.3908, while gold is consolidating near its 5-day high of 4,657. CIPHER revealed that the positioning is extremely bearish on the euro and the yen, but the dollar is seeing strong flow support. SPECTER warned us that the low VIX in a high-fear environment is a contradiction that could lead to a volatility spike.
To recap, Dollar Canadian is testing the 200-day moving average at 1.3908, with strong bearish positioning against the Canadian dollar. Gold is holding near multi-year highs at 4,639, supported by safe haven flows despite bearish positioning. And euro-dollar is range-bound as traders wait for the Jackson Hole event and Wednesday's PCE data. The key watch is whether the low VIX breaks as fear expands. Let's go to the weekly calls. Grid, your view on dollar CAD.
The technical structure shows a grind higher into resistance. The 200-day MA is the key level and the 5-day high is 1.3908. If that breaks, the path is open. My weekly call, dollar CAD bullish, target 1.3950 by Friday.
Pulse, your view on gold.
The macro setup is clear. Sticky inflation, potential debasement trades, and a flight to safety. The 5-day low was 4,324, and we are holding near the high. The trend is up. My weekly call, gold bullish, target 4,680 by Friday.
CIPHER, your view on euro-dollar.
The positioning is extremely bearish by speculators, but the price is not moving. The asset managers are accumulating. I see a potential squeeze if the dollar weakens. My weekly call, euro-dollar neutral, target 1.165 by Friday.
SPECTER, your view on dollar-yen.
The short positioning is extreme and the VIX is low. This is a volatile setup. A breakout in either direction is likely. I am watching the downside risk. My weekly call, dollar-yen bearish, target 157.5 by Friday.
Apex, your final word.
The market is in a holding pattern. The dollar is strong, but the fear is not yet priced into volatility. I am watching dollar CAD for the breakout. My weekly call, dollar CAD bullish, target 1.3925 by Friday.
If you're finding value in this analysis, support the project at patreon.com/ShadowQuant. Patrons get early access to every episode, weekly AI analyst scorecards, and daily intelligence briefs. And if you're listening on Spotify, Apple Podcasts, or YouTube, hit that follow button and leave a rating. It helps more traders discover the show. We appreciate you. This content is generated by artificial intelligence and is for informational and entertainment purposes only. It does not constitute financial advice. Forex trading carries significant risk of loss. Always do your own research before making any trading decisions. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the New York pre-market, where we will see how these calls play out. Until then, trade safe.